You've worked hard to build wealth and protect it for the people you love. And you've probably heard about an Irrevocable Life Insurance Trust, or ILIT. The idea is simple. It's a way to place your life insurance into a trust so that your money is protected and can be used exactly how you intend. In this short video, we'll explain what an ILIT is, how it works in real life, and you'll also learn why it matters, even with the new $15 million federal estate tax exemption. By the end, you'll see how it can help safeguard your estate while providing loved ones with lasting financial security. So what is an ILIT? Irrevocable Life Insurance Trust is a legal structure that owns a life insurance policy on your behalf. Once it's created, the policy falls under the administration of the trust, with the trustee managing it according to your explicit written instructions. Upon your passing, the insurance payout goes directly to the trust rather than your estate, and that keeps the funds protected from costly estate taxes and potential creditors, allowing your loved ones to receive money quickly without delays from the probate process. The IRS itself recognizes ILITs as an effective way to exclude life insurance proceeds from your total taxable estate, as long as you don't retain ownership or control over the policy. In short, an ILIT helps your life insurance do exactly what it's meant to do: provide financial security for your family. So here's why ILITs still matter in 2026. In 2025, Congress passed the One Big Beautiful Bill Act, setting the estate tax exemption at $15 million per person or $30 million per couple. While generous, it didn't make ILITs irrelevant by any means, and here's why. Even with higher exemptions, an ILIT offers clear structure and protection. It creates liquidity when other assets like properties or businesses can't easily be sold or liquidated, and it helps prevent your heirs from having to liquidate those assets just to cover taxes or debts that may be on the estate. The trust also provides an added layer of privacy and structure, ensuring that your insurance proceeds are distributed according to your instructions without public court involvement. So even in an era of higher exemptions, ILITs provide peace of mind and reliable framework for long-term planning. And how an ILIT works? It's really simple. Once your trust is established, the entity becomes the legal owner of your life insurance policy. You make contributions, and the trustee of your choice, who could be a loved one or a professional, uses those funds to pay the premiums. Each time you contribute, the trustee sends what's called a Crummey Notice to the beneficiary. This letter gives them temporary access to the contribution, which keeps that gift tax-free under the IRS rules. And when you eventually pass on, the insurance company pays the death benefit directly to the trust. In turn, the trustee manages that money based on your direct instructions. Remember, your written instructions, providing cash for immediate needs and supporting your long-term family or business objectives. Think Rockefeller. This setup gives your family immediate access to liquidity while keeping the funds protected and separate from your estate. An ILIT offers three major advantages that go far beyond tax advantages. First, it preserves family wealth by keeping insurance proceeds available for your loved ones instead of being reduced by estate costs. Second, it protects assets from creditors or lawsuits, giving your beneficiaries greater financial security. And third, it provides flexibility. Many estates include property or business interests that just can't easily be sold or liquidated. The life insurance held in the trust ensures your family has access to cash when they need it most. Together, these benefits give you control and peace of mind while ensuring your legacy is managed exactly as you intend. To set up an ILIT, you'll work with an estate planning attorney who drafts the trust to meet IRS requirements. And once finalized, you appoint a trustee, someone you trust, to manage the account and keep the paperwork accurate. You'll fund the trust by making annual gifts, which the trustee uses to then pay the insurance premiums. The trust may buy a new policy or take ownership of an existing one, but if you transfer an existing policy into the trust, the IRS's 3-year rule can still include that in your estate if death occurs in that 3-year window. But you also stay in control. The trust follows your instructions, making sure the money is used in the ways that support your loved ones and honor the goals you've set for them. ILITs are effective, but they're not for everyone. Once created, they become permanent, and it can be challenging to change beneficiaries or adjust terms. And while that permanence offers stability and peace of mind, it can also limit flexibility. The trust also requires ongoing attention. A trustee must handle documentation and ensure compliance each and every year. Professional guidance can simplify that process, but it's still a responsibility to plan for. And because ILITs combine tax and insurance law, working with qualified advisors helps avoid costly mistakes and keeps your trust running smoothly. So, when does an ILIT still make sense, and who benefits from an ILIT? ILITs are especially useful for families whose estates are likely to grow. And by keeping life insurance proceeds outside the taxable estate, they can pass more value to the next generation. Business owners who need liquidity to cover taxes or succession costs, as well as residents of states with their own estate taxes, not just federal, also can see significant benefits. Even beyond tax planning, they provide structure and privacy, helping your wealth transfer efficiently while accurately reflecting the values that you have and your intentions. So in summation, an Irrevocable Life Insurance Trust, or ILIT, is a simple yet powerful way to protect your wealth, provide stability for your family, and make sure your wishes are carried out to a T. With the right guidance, it's a trusted way to bring lasting clarity and confidence to your estate plan.